Okay, our next topic is going to be business expenses. For business expenses, again, we want to take advantage of the tax write-offs as much as possible to have the lower tax liability. But where you have to be careful is on the lending side. If you write off too much, you can't qualify to purchase a home. So where do we find that middle ground? So what are some common write-offs that you take advantage of?
So I would say, as it comes in relation to lending specifically, what I see most common, or what people should be sure to address and be strategic about, would be related to vehicle mileage and depreciation. So I know you guys can add those back to the lending approval process, but aren't there certain things of the way that they're reported on the returns that allow that to be more easily done versus potentially not done at all?
Okay, so on our side, lumping vehicle expenses is kind of detrimental because you get the same tax benefit, but if you do it properly on our side, then you can actually have a better impact, because if you break it up into mileage, then we can use that and add that back in, and then you can have depreciation on other equipment. So you don't want to do vehicle depreciation in a whole, you want to do one or the other, mileage or depreciation. So we can add back, but you're saying we can't take advantage of both.
Correct. So you can either deduct business miles used on a personal vehicle, or you can deduct actual expenses related to the vehicle,
Like wear and tear, oil changes, things like that.
Yep, but also depreciation. So depreciation on the vehicle comes under the actual expense method versus mileage. But one thing I can see that would be really beneficial from your side of things that I have not always done on my business tax returns, for clients, is on the separate 1065 and 1120S returns for those partnerships and S corporations. Usually we'll calculate the mileage deduction, but it's grouped to just under automobile expense. But a good strategy would be to actually put on the return as mileage expense so that you guys could add that back. On the Schedule C on an individual return, those miles are on a mileage worksheet or a separate section of the return, so it's easy for you guys to see. The business returns don't have that, but that would be a good strategy to make sure your CPA is doing if you're looking to get approved for a loan, is to actually calculate that mileage deduction, but list it on the return as an other deduction as a mileage.
And we don't have to get super granular, but that amount for that mileage depreciation changes. What is it right now? Like 50?
Yeah, so the mileage rate changes every year. It's last year is 65.5 cents, I believe. Yeah, it did, thankfully so.
But yeah, take advantage of that, because again, that helps you on the tax side and it does not disadvantage you on the lending side.
Yeah, and then for depreciation that you guys add back, that is taken on any business asset over $2,500 per unit. But there could be advantages. We would have to kind of look into that more in specific cases. But to potentially depreciate things and capitalize things that wouldn't otherwise need to be depreciated, because if you guys are able to add it back, then it might be better to do that rather than expensing some items.
And you said it has to be a minimum of a $2,500 purchase.
$2,500 or over, it goes on a depreciation.
Okay, so again, let's use our body shop as an example. My brother has a body shop, so that's what comes to mind first. Is if they buy a paint booth, that's definitely going to be over $2,500, and there's going to be wear and tear, so you can depreciate that wear and tear. Now, what's the limit on that? Is it 5 years you can depreciate that same item, or how does that work?
It actually depends on the asset class. Okay. So a vehicle is a 5-year depreciation period. So you would depreciate that vehicle over 5 years. Although there are some accelerated depreciation things that we can use to advance that depreciation, like Section 179, bonus depreciation, things like that. But otherwise, the actual asset depreciable life is dependent on the asset.